having them get on the phone with you Dmitry, and moving money back and forth. So we got plenty of time, guys, plenty of time before 2021. So I'm not saying to procrastinate, though. That's not what I'm telling you. I'm not saying wait till December 30th. Trust me, I don't want you to procrastinate like that. But all right, everyone. Well, it looks like there are still some people logging in, but for those of you who are here, we're going to go ahead and get started. Thank you so much for attending tonight's webinar. Tonight's topic, year-end tax planning. Like Dmitry and I have been discussing, just major moves and major, implemented strategies to make and to put in play before the end of the year to hopefully result in some major tax savings. That's always the goal through year-end planning. I've always told in every single webinar and every single seminar I've ever given, I've always said that, failing to plan is ultimately planning to fail. That phrase, even though you've heard it a million times before, probably, it goes hand in hand in more than just a couple ways with my industry, the tax industry. Same with Dmitry. I think that, if you put a plan in place, if you get that ball rolling with enough time, and like I said, we still have plenty of time before 2021, before New Year's Eve. I think that by implementing those plans, you'll actually really enjoy the results of all of those plans that you've been able to implement. And remember that it's not about getting you to pay nothing in tax. Sure, that all sounds great to everybody, to pay no tax. And in some very unique situations, if you can get yourself that low, great, you've achieved your goal. But when you are really making a lot of money, it's really about maximizing every angle under the Internal Revenue Code to get you to pay an obligated amount of tax and not a penny more than that obligated amount. I always tell my clients, I can't wait until I actually see my effective tax rate hit 37%, because at that point, I know that I've done really well for myself. At the 37% bracket, sure, it's going to hurt cutting those checks to the government, but I know that I've hit that bracket to where I am above and beyond where, most other business owners and investors are. That 37% bracket, I call it the power bracket. I mean, as much as we all kind of hate the fact that the wealthy of the world pay very little tax, there's just a lot more games that you can play because you have a lot more to work with. And so the whole goal is not really to pay less tax. Yes, that's the goal, is to pay your obligation in tax, but you have to rethink your strategy. You have to think of paying less tax. Instead of paying less tax, you have to think of it as retention of wealth, right? Why do we plan ahead? It's to keep more of our money. We work really hard for what we have. And so if we implement these strategies, the goal, yes, the result is paying less tax, but the goal is really, or should be really, to retain more of that hard-earned wealth that you've built for yourself over the course of the year. So that's my main goal with year-end planning. And so tonight we're going to talk about some major strategies and deductions that you can move about before December 31st to hopefully reduce all of that liability. For those of you who don't know who I am, my name's Tony Watson. I am here on behalf of Robert Hall & Associates. I've been working in the tax industry for going on, I think 17 years now. Robert Hall & Associates will be celebrating our 50-year anniversary in 2021. We started back in 1971, and I handle individual business tax filings, nonprofits, estates, trusts, gift tax returns, you name it, anything filed with the government in the state of California. That's essentially what we go ahead and file for our clients. But then on top of tax preparation, we do a lot of tax planning as well. And so tonight, I'm going to toss the podium over to Dmitry in a couple slides here, and he's going to talk about something that is just an intricate part of tax planning, and that's deferred retirement planning and being able to move money out of your bank account into either a traditional retirement account of some sort or a Roth account, but more importantly, an account that allows you to invest in other things outside of the stock market. So we'll get to that in a couple slides. And I'm also the keynote speaker for Robert Hall. Very privileged, to be able to bring this, very honored, and it's a privilege to bring this information to you on behalf of such a great company to work for, the Hall family. They're incredible business owners. They are great human beings. They're incredibly philanthropic, and it's just a real privilege to be able to work for a firm like RHA. By no means am I a one-man operation. I have got an absolutely amazing senior accounting staff that I support, and they also support me in times of need of support. But when you pick up the phone and call, if I'm not readily available, let's say I'm in the middle of giving a webinar, or I'm with a client on the phone, feel free to ask questions to any of our senior consultants. They're all incredibly knowledgeable in the tax field. They all practice what they preach. About 95% of our accounting staff are real estate investors. And so they, and they all have roughly about 9 to 10 years minimum experience preparing taxes. So feel free to call our office at any time. We do offer free consultations, which I'll give you my contact information at the tail end of tonight's webinar. And kind of along that same topic, with that kind of accounting staff, we are actually able to service tax filings in all 50 states. I myself am a business owner. My wife is a business owner. So I practice what I preach. I'm also a real estate investor. I own some properties in Texas. I owned some properties in Florida a couple of years ago. And I'm in the middle of working some deals as well, again, in Florida coming up. But I very much like to practice what I preach. I talk about things that are near and dear to me. My father was a real estate investor. My mother was a realtor most of her life. My grandfather was a contractor. I mean, I have it in my blood. And also when I came to work for Robert Hall and Associates, I realized very quickly as a tax advisor that the tax world and the real estate world, they go hand in hand in more than just one way. It's not only just reporting income on your tax return that you make through real estate related activities. Real estate will always be, and I truly believe this, will always be one of the greatest tax shelters that you can park your money in. And then you can kind of tie it in with, obviously, the retirement investing and whatnot, which we're going to talk about tonight. But real estate is definitely one of my go-to investments. And I really hone in on planning with my clients for them to eventually catapult themselves into the real estate world. Or if they're already kind of dabbling in real estate investments, we really try to capitalize on all of those successes. So why do you think right now is a really important time to have a conversation with a person like myself or to talk with Dmitriy about retirement planning? Well, as we kind of approach the end of this calendar year, December 31st is the cutoff date for the calendar year, right? January 1st through December 31st. So I always ask my clients, why do you think that December 31st date is so important? Why do you think we need to implement strategies and put together plans to meet specific results by December 31st? And why is year-end planning important to all of you? Well, I get a couple different answers to this question. Some will say, well, I want to avoid any unnecessary penalties and interest. Well, that's a given, right? You don't want to overpay Uncle Sam if you don't have to. Some say it's to better position myself for greater tax benefit, maybe setting up a solo 401k and maxing out that benefit and allowing your retirement to invest in other, real estate related vehicles or any other investments that you park that money in. The most common answer, though, is for peace of mind. I'm not going to say that everybody wishes that they could see into the future. I know that sometimes that can get a little dark, not, trying to know what your future is before it's here. But the main goal with year-end planning is actually to see what your tax obligation is before the year end is even here, right? It's to sit down right now and to put together figures, enough of accurate figures to kind of project or predict what your tax liability or tax refund is going to look like before the year is even over, right? And so essentially that's telling the future, is it not? I mean, that's the whole point of year-end planning, is to just know ahead what you're up against. And that gives people a lot of peace of mind. I can tell you right now that most of my clients that actually sit down and do year-end planning, when they leave my office or our office at Robert Hall after their tax appointment in tax season, the people who have planned ahead, you could tell that they're a little bit more at ease, right? Taxes are stressful. Planning for taxes are stressful. Doing all of this, coming in and talking about taxes in a webinar, it could create stress for some people. But the whole point of this is to relieve you of stress. It's to give you an idea of what the future has in store for you. So there are no roadblocks. There are no speed bumps. There's nothing ahead of you. It's just kind of clear roads out until end of next year. And that should give you a lot of peace of mind, knowing exactly what you're up against, knowing what financial obligation you have to pay come tax filing time. So I'd say that year-end planning this time of year is probably more important than tax season is. Tax season, you got to meet those deadlines, right? I call the tax return a final exam, because, right, you got to get together 12 months of information. You submit it to the government reviews it, checks it off, and nothing's questioned 9 out of 10 times. For those of you who are wanting to build significant wealth for yourself, there are going to come times in your life, in your career, in your business life, where the government steps off of their high seat, their throne, and comes down and questions something on your return. There's going to be some time like that. In fact, I've been told by most of my 1% clients, the clients who make $500,000 and above, that they feel like if they aren't ever questioned, not audited, but getting some sort of correspondence from the IRS, that they're not doing something right. As you make more revenue, yes, there will be a thicker microscope kind of hovering over your tax return. But like I said earlier, I can't wait until I hit that 37% bracket, because at that point I've known that all that hard work, all of that determination, all of those good financial moves I've made for myself have made a difference in my life. So I can create more legacy for myself, to leave my family with something, to be more philanthropic, to give back to the people who need more than I, that need more in their own lives. So there's a number of reasons why people put together a year-end planning appointment. And we are here and readily available to assist. And we still, once again, have plenty of time leading up to the end of this calendar year. In this meeting, though, what do we call this? Do we call it a year-end consultation? Do we call it a 2020 wrap-up consultation? No. Well, in the tax industry, I mean, you can call it whatever you want, but in the tax industry, we call it a W-4 review. Now, W-4 reviews can come in two shapes, or two different forms. One is a plan based for employees, or put together for employees. One is a plan put together for self-employed individuals or rental property owners, individuals who have not compensation like a W-2, but have other self-employed earning type revenue streams. And the W-4 review is really meant to sit down and map out your year-to-date information, and to kind of predict or project what your 2020 tax liability is going to look like. For an employee, it's a lot easier. An employee has a paycheck stub. And so essentially during these W-4 reviews, we take a look at a paycheck stub. We figure out year-to-date taxable income. We figure out what they've prepaid in federal and state income tax, what they've withheld. And then we tell them essentially if they're on track to receive a refund, or to pay a little bit, or maybe even to break even. With a self-employed individual or a real estate investor, it's a little different. There's a lot more information that is involved in this W-4 review. We need year-to-date revenue. We absolutely need year-to-date expenses. And that gives us a year-to-date figure of what your projected profit is. But that's not where we stop, right? Because we have more time before the end of the year. So sometimes in these W-4 review consultations, we'll send clients back out into the world. I call it the wild nowadays. We'll send clients back out into the wild so that they can take all of this profit that they're going to eventually pay tax on, and potentially take some of that profit and continue to reinvest it back into their business. See, the greatest thing about knowing about tax code is knowing that every dollar that I reinvest back into infrastructure is a dollar I avoid paying tax on, not evade. Remember, tax evasion is illegal, tax avoidance is not. So through a proper plan, you should be figuring out year-to-date expenses and year-to-date profit. So income minus your expenses year-to-date. And whatever that profit is, you have 20 days, 21, 22 days left in the year, with a lot of sales on the table with the holidays coming up. You're going to see a lot of people out there upgrading computer equipment, maybe even buying a new vehicle, making improvements to their rental investments, capturing deductions before December 31st so they can get a benefit for that in this calendar tax year. Now, for those of you who are self-employed, you're probably used to prepaying some of your tax. And, some of my clients have said, well, how is this calculated? I feel like I'm prepaying more this year than I was last year. Well, actually, that is the case. The computer system, the IRS wants all of these tax software programs to calculate one of two numbers for prepayment of liability. And remember, December 31st is not the deadline to pay your tax. January 15th, the end of the fourth quarter, actually is the deadline to pay at least one of two calculated numbers, which I'll get to in a second. April 15th and October 15th, they are only filing deadlines. They are not deadlines to pay your tax. That's a general misconception. So understand that January 15th, the end of the fourth quarter of the year, that is when you have time, or the deadline, to prepay either 90% of your current year liability or 110% of the previous year's liability, whichever tends to be greater. And so if you made less in 2020 than you did in 2019, well, obviously you're not going to pay 110% of a higher income year, right? Because you made less this year. So you might want to skip that fourth quarter payment and get you down to a lower amount, because naturally you made less, so you pay less tax. Or if we can do some planning before the end of the year to drop your income even lower than it was last year, then maybe we can avoid that fourth quarter payment as well. If you made more this year than you did in 2019, which a lot of my realtor clients, I'm getting calls from them saying, hey, we collected unemployment in maybe June or July, but after July and August passed, our revenue shot through the roof. People were back to work because of the low interest rates, right? So I saw a lot of my realtor clients actually pumping figures, sometimes even higher than what they had made in 2019. So we needed to adjust their fourth quarter payment and maybe throw the government a much larger bone towards the end of this, fourth quarter. And so you have to cover one of those two numbers to effectively avoid altogether penalties and interest. So just be aware of that. The year-end planning, whether you're an employee or a self-employed individual, year-end planning is equally as important. It's not more important for a W-2 wage earner versus a self-employed individual business owner. Doesn't matter who you are. It's always important to have a plan in place and let tax advisors, licensed advisors, map out this strategy for you. Because if you end that year without talking to a tax professional, you're probably not going to like the results. I mean, you'll be okay with them because it is what it is in most cases, but you're not going to be happy with the bottom line number because you didn't do the necessary planning. So a lot of what we do right now towards the end of the year is just mapping out those strategies for our clients. A very, very important part of the tax industry year-end planning. So as we approach the end of the year, talking about some very specific tax deductions to max out. If I am a self-employed real estate professional, if I'm a real estate investor, if I own an Amazon online business, if I'm just a contractor making consulting or contracting revenue, nonetheless, if I'm a business owner, a self-employed individual, or I have other income that is not W-2 or unemployment or Social Security, if I have actually earned revenue, what are some deductions that I really need to look for before the end of the year to further reduce some of this taxable income? Well, I mean, if your business is growing and you're not marketing yourself, you got to plug money into marketing and promotional expenses. This is truly the only way to get your name out to the general public. The government expects businesses that have significant jumps in revenue from year to year, they expect to see marketing and advertising expenses written off on their return. Robert Hull & Associates, we do a lot of marketing. I'm sure Sense Financial does a lot of marketing, a lot of promoting of their business. I mean, this is an organic way for a business to grow. And when I say organic, I mean, it's just one of the more common deductions amongst all of the write-offs. But, word of mouth is definitely a more organic way if you're talking about the definition of organic. But marketing and advertising, the government expects businesses to have this expense. And at the end of the day, every marketing and promotional expense, advertising expense that you pay for, it's going to be a dollar for dollar deduction against your income. So great overall expense, great way to further reduce your income before the end of the year. Now, professional supplies and equipment, one of my favorite deductions. I know I'm such a nerd, but at the end of the day, I love equipment. I love supplies. I love furniture purchases for businesses because one, it has one of the lowest risks for audit on a return. And two, you have options of how to write these expenses off. So when you purchase a cell phone, think about this for a second. How many people do you know in business who can do what they do without a cell phone? How many people do you know who operate a business who don't use a computer, who don't sit at a desk, who don't sit on a chair, who don't have shelving units and storage? I mean, you're talking about some of the most common business write-offs of anything, right? So these expenses tend to have less than probably a 0.1% chance audit. In fact, in 17 years of working in the tax industry, I have yet to see an audit on a cell phone purchase, an audit on a computer purchase, a printer, a fax machine, a desk, a chair. Now, if you go out and you buy that $10,000 restoration hardware table and you try to write off that as a desk, well, yeah, I mean, not everybody is lucky enough to have a $10,000 desk. And at that point, you're trying to push the envelope a little bit. I like the way you're thinking. But at the end of the day, it might be too much of a push or too much of a bending of the rule to get away with that. So that might raise a little bit of risk for audit. But I'm talking about the actual desks, the chairs, the cell phones, the equipment. These are great overall write-offs, very low risk for audit. And let's say that you already are at a balance of zero liability to the government. You've been able to reinvest all of your profit back into infrastructure and you don't currently owe anything to the government. Well, why would you try to force a $2,000 MacBook computer deduction on your return if you're already paying no tax, right? Think about that. If I'm already paying nothing in tax, why would I miss out or why would I capitalize on this deduction when I didn't actually need it this year? So the government allows equipment and furniture to be depreciated over the lifespan of the asset. A computer, for instance, has a 7-year lifespan. A desk and a chair has a 5-year lifespan. So you have the choice to either take it all in 1 year as a deduction or to deduct it over the lifespan of the asset. So if you don't need the $2,000 computer write-off this year, you could take it over the next 7 years. Well, let's say 2 years down the line, your profit bumps back up to whatever a normal level of profit is, and you want to take that deduction or the remaining part of the deduction in that year. Okay, the remaining 5 years, you can accelerate and take the remaining 5 years of the deduction all in that year when you actually need the write-off. So once again, supplies, equipment, furniture, love that deduction. Have this conversation with a licensed tax advisor. Car and truck expenses, very unique deduction. Leasing is more, in my opinion, this is just my opinion, okay? Leasing, in my opinion, is more of a lifestyle choice. It allows you to kind of trade in a car every 2 years, allows you to have a little bit nicer of a vehicle. You don't have to pay for the maintenance on it. You just return it. They give you a loaner car. So a lot of people, especially here in Southern California, in the real estate industry, they will opt to lease these really nice vehicles. Not everyone, but a majority of clients do. They want that new Mercedes, that BMW at $300-500 a month minimum. And they get a nice write-off for it. It has to be split between personal use and business use, but at the end of the day, a pretty consistent overall write-off. As of 2018, the federal government brought back a different benefit if you purchase your vehicle. So if you purchase a vehicle that is more like a sedan that weighs under 6,000 pounds, that pound number is very important to understand. If the vehicle weighs under 6,000 pounds, the upfront deduction you get in the first year is about $18,000. If you purchase a vehicle over 6,000 pounds, you get 100% of that depreciation deduction fully in 1 year. Not everybody will qualify for this, but it's a great conversation to have with a tax advisor. Meaning that if I'm looking at about $100,000 in profit through a self-employed business, and I go out and I purchase a 6,000 pound or heavier Chevy Tahoe, and I buy it under my business, and it's at $65,000-70,000, the government will actually allow me, in certain instances, if it's solely used for business, titled and insured under my company, I can take that $60,000 purchase, a $65,000-70,000 car, and fully deduct it against $100,000 in revenue. Meaning that on my federal return, I don't pay tax on 100K. I pay tax on whatever the leftover profit is. California does not allow for this. So understand that California will still tax you on the 100K, but the IRS will allow you to reduce your taxable income by whatever that dollar value is. You don't even have to pay it outright. You just have to finance it, put $5,000 or $10,000 down, finance the rest. You still get the full value of the vehicle as a bonus depreciation write-off. There's a couple other conversations to have about that, but I really don't want to spend too much time on that. I do want to get to Dmitry's topic for the retirement planning topic as well. But if you are already looking for a vehicle before you purchase a vehicle, okay, and I'm not going to send you out just to buy a vehicle for the tax write-off. I do want you to understand that if you're already looking for a vehicle, before you buy it, have a conversation with your tax advisor. Maybe there is a creative way, not breaking the rules, but pushing the envelope a little bit to capture more of that depreciation write-off and save you some significant tax liability in 2020. So talk with your tax advisor before you do anything there. Legal and professional fees, most cases dollar for dollar tax deductible, especially if you're self-employed or have Schedule E rental income. There's a whole portion of the tax return where you can plug in legal and professional fees. They're going to be dollar for dollar write-offs for you, okay? Property deductions, we have to dive into two subcategories essentially for property write-offs, either a primary residence or a rental investment, right? Because they're treated differently under current and old Internal Revenue Code. So we have to break it down. On a primary residence, a home that you actually physically live in, the home that you live in, you are limited to what you can deduct in mortgage interest and property taxes. This also includes, by the way, a second home. Okay. So on a primary residence, the home that you live in, if you bought this home prior to December 15th of 2017, you're allowed the interest on up to the first $1 million of debt. If you bought that home to live in after December 15th of 2017, the new rule states that you can only deduct the interest on the first $750,000 of debt. So once again, if you bought it under the old tax bill, good, you're grandfathered into that $1 million limit. Under the new tax bill, interest is only deducted on the first $750,000. This is $750 for your primary and $750 for a second home. We're not talking about rental properties yet, okay? So primary and second, $750 each, not $750 total, so $750 each. When it comes to property taxes, it's a different story. Property taxes, which we refer to as the SALT deduction, state and local tax. SALT deduction includes your property taxes on your primary residence, property taxes on a second home, and the state income tax that you pay to the state of California. So it could be a pretty sizable number, right? 20, 30, 40, 50 plus $1,000, depending on what kind of value your properties are at and what you pay in property taxes, and then also what you pay to the state of California in income tax. So you're thinking, okay, well, I pay all of that money, at least I get a write-off for it, correct? Well, in 2018, the federal government said your SALT deduction total on both a primary and a second home, max state and local tax deduction you get is $10,000. Okay. So under the old tax bill, there was already a limit. It was called AMT, alternative minimum tax, actually already capped and limited or fully disallowed your SALT deduction. So this is nothing new. It's just more defined under the new Internal Revenue Code at a $10,000 cap. So if you have more questions about how that new tax bill impacted you specifically, that's a great conversation for you to have with us. We'll review 2 years of tax returns for you, tell you whether or not you were affected by that change between 17 and 18's tax returns, and kind of map out a strategy to navigate around maybe some of these limitations that could be causing you to pay a little bit more tax. There's very much interpretation of the code, by the way. That's a real thing. We're not going to break the rules, but we can interpret the code differently for different professionals. And we interpret it based on case study. We don't ever just throw out our opinion about a tax code, right? We look at case study and we say, well, in the 9th District Court, they passed this for this individual in this industry. So yes, we can apply that part of the code to your tax return. And so hopefully sometimes we can navigate around some of these roadblocks or limitations and be able to capture some additional write-offs for you individually, especially if you are incorporated. If you've got an S Corp or some other entity where you've been able to shelter a lot of your income, man, the games that we can play with that, once again, within the 4 walls, hypothetical walls of the Internal Revenue Code, the games are limitless. And so I think that very much so are we professionals and specialists in small business and real estate taxation. So, give us a call if you have any of those questions. So that's on the primary and the second home. A rental property really has no limit. Rental income, anybody across the board can deduct expenses on a rental property to the extent of rental income collected. You collect $50,000 in rental income. If you have $50,000 in expenses, everyone is allowed to offset that rental income fully and not pay income tax on the $50,000 collected. Now, not everyone will be allowed a loss deduction, meaning that if you have $50,000 in rental income, you have $80,000 in expenses. Sure, you're not going to pay tax on the $50,000, but the $30,000 loss for some of you may not be tax deductible. And in that case, if you are limited on the loss deduction or the loss benefit, you don't lose it. You just can't use it in certain instances, especially if neither you or your spouse are real estate professionals. And if your AGI, your adjusted gross income, is above $150,000. So there are a couple other limits that you need to be aware of. These are things that you need to have discussions about with your tax advisor. But that $30,000 loss is not lost. You just can't use it. So it carries forward as something called an unallowed passive loss carry forward. And it is fully deducted if one of 2 things happens. One, if you sell the property that the loss is attached to, so in the year of disposition, you could fully take the loss. Or if your income drops below $150,000 AGI, adjusted gross income, you start to phase back in to the loss deduction benefit. But if you're not a real estate professional, the max loss, if your income is below that phase out threshold, the max loss you can take per year is about $25,000. So once again, very complicated parts of the Internal Revenue Code. You need to work with a tax advisor who understands the ins and outs of some of these limitations. Like I said, there are some creative ways, some interpretations of the code that may be able to kind of navigate around some of these limitations. But we got to map those strategies out with you directly, one-on-one, based on your tax scenario. We can't just cut and copy somebody else's tax return plan, right? Everyone's tax return is unique. Everyone's tax return is different. So have a conversation with your tax advisor based on what your tax return says, not based on what your neighbor or your coworker or your family member or friend told you about what you should take advantage of. Okay. Oh, hey, I incorporated. You should go incorporate. No, that is bad advice. Only take that advice from somebody who is a licensed tax advisor. Okay. I can't stress that enough. Now, as we approach the end of the year, obviously the conversation of retirement planning comes up. And so I'm going to toss the mic over to Dmitriy, and he's going to upload his PowerPoint to the screen here in a second. But a lot of our planning, during these year-end planning sessions, these W-4 reviews, happens to bring in the retirement planning as well. Do we defer X amount into a retirement plan? Do we really want it kind of legally gambled into the stock market at the moment? I mean, one tweet from our president could send the Dow down 600 points. One tweet about the coronavirus and the vaccine being successful could throw the Dow up to all-time records, right? I'm not saying that it's anybody's fault by this. It's just there's fragility, there's volatility in the stock market. And so a long time ago, when I first met Dmitriy, obviously, the self-directed retirement account kind of vehicles have been around for a very long time. But man, it was a match made in heaven, because I'm a real estate guy. I love real estate. I love talking about real estate. I love investing in real estate. And when I realized as a tax advisor 17 years ago, when I started to really kind of gain traction in my field and develop my client list, when I met Dmitriy, I thought, man, this is a match made in heaven. I need this guy to set my clients up with retirement vehicles where they can invest in things outside of the stock market. So Dmitry, I'm gonna stop sharing my screen here for a second, and I am going to promote you so that you, I'm not going to promote you. I'm going to give you a raise. No, I'm going to promote you to host here so that you can share your screen, and you should be able to share it now.
All right, let me find that.
Should be at the middle bottom of your, yeah.
Okay, can you see that?
Beautiful.
Okay, great. Well, Tony, great job. And I'm not going to take much time here. I just want to show you guys, because this, like you said, it goes really hand in hand with tax planning. And I'm going to focus today specifically on the solo 401k, which is considered the ultimate retirement plan. So what is it? Basically, it's not a new type of plan. It's a plan that is designed under Internal Revenue Code Section 401, and it's designed for those people who are self-employed or own a small business. Increased interest in this type of plan was as a result of changes in the tax law in 2002. And that change made all the benefits that I'm about to share with you possible. So let's talk about the eligibility. Who is this plan for? You have to meet two criteria to qualify for this. Number one, there must be a presence of self-employment activity. It can be in any type, shape, or form. You can be a doctor working as an independent contractor, attorney, consultant, and on and on and on. So if you generate any kind of self-employment income or involved in the self-employment activity, you qualify. And then number two is the absence of full-time employees. The law says that if you have somebody working for you more than 1,000 hours a year, then you must offer retirement benefits to them. So solo 401k will not work in this instance. So essentially, if you do have a business with full-time employees, that's the only thing that will disqualify you from participating, because you can always start a side business. There are many benefits to that, including ability to qualify for a solo 401k. And as I mentioned, absence of full-time employees. All right, so how does it work? Solo 401k, I'm using this chart today to demonstrate to you a flow chart. Number one, there has to be a plan sponsor, and a plan sponsor can be somebody who is just self-employed, let's say a real estate agent or a nurse who's working as an independent contractor. If you do own a business like a corporation, LLC, or a partnership, certainly that entity can act as a sponsor of the plan. Next, we establish the plan and trust. So as a plan sponsor, you adopt a plan and we create plan and trust. In this case, the trust is used as a vehicle to hold the plan assets. You become the trustee of the trust, and as a trustee, you control plan assets. At this time, you as a trustee can open a business checking account at the bank or any other financial institution in the name of the 401k trust, which is, again, is a separate entity. It's a separate legal entity with its own unique name and its own tax ID number assigned by the IRS. And when that tax ID number is assigned, IRS knows that it belongs to a tax-exempt entity or retirement plan. Once this is established, then you as trustee direct how the funds are invested. So you can buy a piece of real estate, you can do alternative assets, you can do a private loan, and you can invest in conventional assets as well. You can have a brokerage account and buy stocks or mutual funds. The beauty of this is that there is no one in between. So basically, you are in control. There is no middleman, unlike with a self-directed IRA. So there is no custodian. You as trustee control plan assets. All income is flowing into the 401k trust bank account, and all of the expenses, if you own an investment that requires some expenses, for example, as a rental property, there might be some expenses, property taxes, insurance, perhaps some repairs, and so on. So as a trustee, you simply can write a check and make that payment for the expense. Now let's quickly cover the benefits of the solo 401k. Number one, and that's where it really fits into the year-end planning, is the ability to make large contribution limits. With the solo 401k, there is two components that you can contribute, because essentially you're wearing two hats. You're wearing a hat of an employee and a hat of an employer. So as an employee, you work for the business. Let's use an example of being a real estate agent. So as a real estate agent, you go out, meet with the clients, you show them the property, you make a sale, you generate commission. So as an employee of your business, you can contribute up to $19,500 for this year. And if you're over 50 years of age, then there is additional $6,500 in catch-up contributions for a total of $26,000. You can contribute up to 100% of your self-employed earnings. So if you're doing this part-time and you generated, let's say, $28,000 in self-employment income in a year, most of that can go into solo 401k, 26 grand. Please note that this component or this contribution, you can make it pre-tax as well as after tax in a Roth. Each plan that we establish comes with the Roth component, allowing you to make post-tax contributions into designated Roth account. And on top of that, the business can make additional profit sharing contribution. That's up to 25% of the self-employed compensation. If you're a sole proprietor or a single member LLC, that will be 20%. It is made in the pre-tax dollars, and it's always deduction for the business. Unlike with employees salary deferral, you have an option of making that as a Roth. You don't have that option for the profit sharing contribution. It's always a deduction for the business. However, if you wish to funnel those dollars into Roth, you can do so, because the plan allows you to do a Roth conversion. So you can actually make a contribution, get a deduction for the business, and then you can convert those amounts into Roth and pay the taxes in the same year. So it's essentially, it's going to be a wash. The total limit for this year is $57,000. And if you're over 50, that limit raises to $63,500. I mean, think about this, what the bottom line impact is going to be on your taxes. If you're in business for yourself, especially if you're a husband and wife team, if you're working together in the business, you can potentially shelter over $100,000 of your income from taxes. Proverbs 21:20 says, "The wise man saves for the future, but the foolish man spends whatever he gets." So this proverb works very well with this vehicle, because it allows you to really put away money towards retirement. And think about this. Would you rather send that check to Uncle Sam, or would you rather put that into your own retirement account that you control and you can invest, and then you can benefit and use that later on at the retirement? The next benefit is the ability to actually borrow from your 401k. It comes with the loan feature, allowing you to take a loan up to $50,000 or 50% of the balance at the prime +1 interest rate. And you can use this for pretty much any purpose. So it's a great feature. You don't want to abuse that because, again, you pull in your own retirement money and you're going to have to pay it back with the after-tax dollars. But it is there available for you to use should you ever need that. So it's like you creating your own bank that will never turn you down, because you are the one applying for a loan and you as the plan administrator actually approving the loan. As I mentioned, there is an ability to make Roth contributions. And unlike with the Roth IRA, there is no income restrictions. With the Roth IRA, if you're making over a certain threshold, you're not allowed to contribute to a Roth IRA, although you can do a backdoor contribution. With the solo 401k, you can contribute up to $26,000. Even if you have a high income, say $1 million, you can still contribute to a Roth 401k. And next is the ability to have checkbook control, because there is no custodian with this. You control this as a trustee of the trust, and you basically indirect control. So if you want to make an investment, you can make that as simple as writing a check. They're very easy to operate because there is no requirements for the, as far as the filing requirements, except Form 5500 EZ. Which is required to be filed with the IRS and report the plan assets. If the plan assets exceed $250,000 at the end of the plan year. And it's very simple form. It's only 2 pages to complete, and we do assist with that. So those are, I know I kind of flew over the benefits, but I just wanted to give you a flavor how much beneficial it can be to you at the end of the tax year, especially. And December is super busy time for us today. I think we got 5 or 6 or 7 new clients just today alone, because people they're dragging to the last minute, and they're waiting for basically dragging their feet. But like Tony said, there is still time to do it. If you are eligible and if you wish to get the tax deduction, there is still time to set up the plan and take advantage of the deduction.
That's right. I mean, Dmitry, you make it sound so simple. It's such an intriguing world, the solo 401k world. I forgive my ignorance earlier. I usually go to like the self-directed description of a retirement plan, because that checkbook control, it's really you self-directing your own retirement. But I know in the retirement world, it's solo 401k and then self-directed retirement plan. So I meant earlier the solo 401k, and I talk about it all the time, but I usually end up just saying, well, you got to talk to the specialist. You got to call Dmitry. So I usually send my clients your way, and they've always come back just pleasantly surprised at how much information you have available for them on this solo 401k vehicle. But in the past, I've had clients kind of express their concerns with the IRA vehicle, like not being able to borrow past a certain time frame. I think it's a 60-day period where you have to put the money back. And solo 401ks, there's so much more flexibility, it seems, with this type of retirement account. And like Dmitry said, why would you ever want to pay the government when you could just pay yourself and avoid paying tax on all of that money? And with these high thresholds that you are allowed to put into these 401ks, I mean, those are dollar for dollar deductions, both on the federal and the state side. This isn't just a benefit on the federal side, like that car deduction I was telling you about. This is a dollar for dollar reduction benefit on the federal and the California side. So, and then obviously when you park your money in that solo 401k and utilize it to buy real estate and doing all these other creative things in retirement, all of that money that you're making, tax-free, right? Until you retire, and then you pay tax on it for the traditional side, or not the traditional, but the 401k side. The Roth component has become a very popular thing as well, because you've already paid the tax on it. And at the end of the day, when you retire, you're going to access all of that, the return on investment, and not have to pay any tax on it. So it's a beautiful thing. Thanks, Dmitry, for always making that so much easier to grasp the concept of solo 401k investing. And I've always said to my clients that, you got to talk to the guy who pretty much wrote the book on solo 401ks, which, over, gosh, how long have we known each other? What, 12, 13, 14 plus years?
It's probably close to 15 years.
Yeah. I'd say closer to that too. It's, and so, it's just so unique. How often, in your opinion, would you say the legislation changes around solo 401ks? Are there changes on a year-to-year basis, or has it been pretty consistent?
Well, there are changes. For example, the contribution limits going up every couple of years, and there are minor changes. They don't really affect the overall structure of the 401k. So there are certain things we got to do on the back end to implement those amendments and make them part of the plan, but it doesn't really affect the consumer or the client.
I love it. I love consistency. That's the whole thing in the tax world too. We're looking for things that stay consistent and don't really change for our clients that much, because, with change, sure, it creates more opportunity for us to meet with our clients and change things and help them through it. But it also creates more stress in people's lives, not knowing essentially what the rules are now. So then you got to talk with a financial advisor and everything. But that solo 401k, man, the flexibility of being able to borrow, the tax deferred benefit of building wealth in real estate, or even real estate syndications. I have a lot of my solo 401k clients buying into syndications and, other types of real estate vehicle investments. It's just a really, really unique opportunity. And I'd suggest if you've even thought about it and you're kind of on that tipping point, I don't see why there would be a tipping point. You should already be jumping through that hoop, getting ready to defer money into these solo 401k investments. So great overall vehicle. Thanks for sharing all of that, Dmitry. Can you toss the share screening back to me? I think
okay.
I think you just have to click my name and make me host again, and then I'll wrap up my end, and we'll send everybody back to their wonderful evenings.
Okay, so Tony, help me out here. Where do I click?
If you go to the panelist section in the participants and you
Okay.
click the more, it should say on my name, it should say make host.
Okay, let me see. Let me find you.
Oh, you know what? Actually, I think I can. Oh, I actually have a button that reclaims me as the host. So
Okay.
I didn't. Hey, they made it easier. You know, technology. It's making everything a lot more efficient. So let me flip back over to the last couple slides here. So obviously, as we approach the end of the year in planning, talking about the solo 401k vehicles, another major conversation that I've been having with my clients is the asset protection side of things, especially for my rental property owners. Some clients have said, and I'm glad Dmitri's on the call. Dmitri, come back really quick. I have one question for you. When you buy property under a solo 401k, and this might be more of a conversation for an attorney, but when you buy a property under a solo 401k, I hope he didn't leave. When you buy a property under a solo 401k, is it suggested to also have that property in an LLC? Dmitri, do you happen to still be there, or maybe hopefully the volume's
Yes,
up?
yeah, I'm here.
Okay. Would you suggest that maybe once again, maybe this is a better question for an attorney, but would you suggest before they acquire property in the LLC for that property to be in an LLC under the solo 401k?
The LLC is not needed with the solo 401k. They can buy the property directly in the trust because again, it's set up as a trust. It's possible to use an LLC for, I guess, limited liability protection. Although again, it is limited. It's not, a full. I always tell folks, if you are concerned about the liability, number one thing that you got to do is you want to make sure you get adequate amount of liability protection, liability insurance on that property. You can bump it up to $1 million. And then on top of that, you can get umbrella policy, which is very inexpensive.
Gotcha.
And then, as a third layer of defense, I guess you can go the LLC route. But it's completely unnecessary with the solo 401k to use the LLC.
Got it. So see how the rules kind of change when you have property under a trust, which is owned by the solo 401k. See, outside of that, you have the realized gain within the retirement, within the actual cash flow. And so you also are looking for not only the great insurance policy, but in most cases, an attorney would probably also suggest another added layer of protection by having that property titled under an LLC. Before you jump through that hoop and start transferring title into LLCs, if you have debt attached to that property, you always want to double check with the lender to make sure they're okay with that property transfer. There shouldn't be any reassessment of property tax if ownership isn't changing. Remember, if you own the property outright 100%, you transfer the property into an LLC that you also own 100%. The county assessor's office will have sheets of paper that you can fill out, little forms that you fill out that show that ownership really isn't changing. You are just acquiring it or transferring the property for asset protection purposes. But the county assessor is really helpful with all of those forms as well. So once again, dealing with retirement plans like a solo 401k that own property, the rules are a little different, or the suggestions are a little different. So that's why you might not only need a tax advisor mapping out the tax side of things, you need to talk with Dmitry and Sense Financial to figure out, kind of how the whole puzzle is put together. So that's a lot of the back and forth that we work with, Dmitry on, is to figure out the best structure for all of our clients. And obviously the end goal is to shelter money and pay less tax. And this is a very, very great and creative way, safe way to allow you to pay yourself and not have to pay Uncle Sam on all of this deferred revenue. So be aware of that. Now, obviously, 2020 has been a very, very unique year. One of the major impacts of the COVID-19 pandemic at the IRS level, major IRS layoffs, which have caused longer processing times, erroneous letters, sometimes even rejections of tax returns filed. We're still dealing on the back end with a lot of identity theft from 2016, 17, and 18. So ID pins, rejecting e-files, incorrect assessments, lender or borrower complications. I mean, you name it. 2020 has been the challenge of all challenges, right? Just understand that we will get through all of this. Things will return to some sort of normal, whatever that new norm is. But overall, you also want to be able to access your tax advisor for communication or correspondence with back and forth with the IRS. Make no mistake, when you call the IRS, there are long wait times. You call a 1-800 number. We call a 1-866 number, which is the practitioner priority line, which allows us to kind of have an expedited connection with the Internal Revenue Service. So just be aware that when you call the IRS, a lot of the frustrations kind of wrap around how much time you have to spend on the phone versus just dishing it off to the, your tax preparer and having them make connection. Now, we might have requests on the back end to get documents from you and whatnot, but you should really be handing that off to your tax advisor and letting them handle conversation with the IRS. So just be aware of that. This is something that has been incredibly frustrating on my end, because when I call the IRS, I'm not an angry person. I don't yell at people, but there have been some times where I just want to reach their phone and say, hey, agent, can you just expedite this for me? I know you have the power to do this. Please do it. But this is the year of patience. I've tried to adopt patience more than anything. But through that patience, through that adopting of patience, I feel like I've been able to work more efficiently with IRS agents, because we're all going through somewhat of the same thing, right? In different ways, but we're all being impacted differently by the COVID-19 pandemic. So just be aware of what's going on, be patient, but more importantly, be in communication with your tax advisor. Now, I mentioned earlier that we do offer free consultations. You have Dmitriy's information. If for some reason you've lost his information, we have it. You can always reach out to us. We'll forward you that information. If you forget our information, Dmitriy has our contact information. But part of this free consultation, what you get out of this free consult, is a review of previous year's tax filings. We'll check for any possible audit triggers on those returns, make sure that we correct any of those changes, and then also check for anything that needs to be amended, anything that was forgotten and needs to be added. And then moving forward, putting a plan in place for not only 2020, but 2021. As much of the information that is still uncertain in the future, we can still map out a strategy for 2021 and kind of talk about different scenarios that may happen. So utilize that free consultation just to talk with us, just to chat with us, but make sure that you have all of your questions dialed in to really maximize that time on the phone with our senior preparers. And also to add you to our periodic tax email updates. We'll let you know about upcoming changes with the tax code, and also, most importantly, to let you know about our free educational webinars. All of our education at Robert Hall is free. We don't charge for any of the webinars, any of the in-person seminars once we're back to doing things in person. So if anything, sign up for the free education benefit. The way you do this is you open up your web browser, you go to www.roberthalltaxes.com/consult. Give us all your contact information so we could send it off to people to call you. I'm just kidding. We don't give your information to anybody. This is just for our database. We will reach out to you. We'll get you set up for the free consultation. If you don't want the free consultation, you just say, hey, listen, can you just let me know about upcoming webinars? That's really all I want. So you could choose to take it or not, but we are here and available to answer any of those questions that you have. And most importantly, we're here to be a support system for you. Just like Dmitrij and our relationship with Sense Financial, we have a number of referral sources. After 50 years of being in business, the Hall family has a very, very extensive Rolodex, so to speak. So if you ever are in need of a professional, obviously Dmitrij knows a lot of the same people that we know, but once again, you can utilize either of our services to be put in contact with other industry professionals to answer any of those questions that you may have. Now we'll open up for Q&A. I think that there might be a couple questions in the chat box. I'm just having a conversation with one of my clients, Steve. Good to see you, Steve. Any Q&A. And if there isn't Q&A right now, I know that it's getting kind of late. You can always hop over to the free consultation, contact us later at a later time. But if you do have Q&A, we'll stick around and answer a couple questions. And once again, if it's late and you guys want to go and have dinner or be with family, by all means do that. But we are here and available through the end of the year to answer those questions. Most importantly, this free consultation, it's incredibly beneficial for a number of reasons. Not only because we want to connect with you and kind of find out what your strategy is, because the more information we have from taxpayers, the more beneficial we are to our clients, because we have scenarios and case studies and other information. We just have a wealth of knowledge at Robert Hall and Associates. So questions are always great. I've always told my clients, don't ever think of a question as a stupid question. Some clients say, Tony, this is a stupid question. I say, no, stop right there. No question about taxes is stupid. I've been doing this for 17 years and I still learn some things based on case studies. So just be aware that there's no such thing as a stupid question. Oh, Steve, what is the max contribution to my Roth IRA? So if it's a Roth IRA, not a self-directed Roth IRA, the Roth IRA is max If you're over age 50, it's up to $7,000, but normally the contribution is about $6,000 if you're under age 50. So it's either $6,000 or $7,000. And remember that Roth IRA contributions are also only allowable for certain income thresholds. Once you breach, I believe, and I'd have to double check on this for you to look at the revenue phase outs. I think for married filing joint, the threshold is above $200,000 AGI. But don't worry, you're not allowed the contribution. It's just you have to come at it from a different angle. If you're a high income earner, you would contribute to a traditional IRA and then immediately convert as through a backdoor Roth conversion to convert that traditional IRA into a Roth. So even for high income earners, there is still a way to kind of navigate around some of these limitations. One way is a backdoor Roth conversion. So Steve, we can always map that out. You can call me or shoot me an email or however you want to connect with me. Eric, I'm acquiring 3 properties by the end of the year via land installment contract. Is it safe to get the cost segregation and accelerated depreciation to include for 2023 properties by the end of the year via land installment contract? So remember that the land, I don't, once again, just to be very, very detailed with this, land, not depreciable, right? But if you are buying property, the building would qualify for cost segregation. Now, do you have enough time between now and the end of the year to get that pushed through? I can't really speak to the truth on that. I don't really know how long it takes for a cost seg analysis to fully be processed. I believe that it's going to take longer than 2 to 3 weeks, to be real honest with you. So you might not have enough time. I know that I said that there's plenty of time to do planning, but this particular analysis tends to take a little bit longer. So I do not know if you'll be able to achieve that by year end. I would absolutely tomorrow morning call a cost seg specialist. If you need a recommendation, I'm sure Dmitriy, do you have any recommendations for cost seg?
Yes, I do. I don't remember offhand, but yeah, I can get that.
Yeah, same with us. So if you need a recommendation or if you just want to look up someone online or through your networking groups, by all means, call them ASAP. But I believe it's going to take a little bit longer than the remaining 3 weeks we have in this year to achieve that cost seg analysis. Are you able to have IRA and a solo 401k at the same time? You can have both. As far as contributing, remember, there are certain limits that you can't go over. And so if you do over contribute, there might be an add back of income to your return where you pay tax on. Dmitriy, can you speak?
Let me add to this. So you certainly can have an IRA and a solo 401k at the same time. If it is a Roth IRA, then that is a legitimate question. You can certainly have that. If it's a traditional IRA, typically you don't really want to have that traditional IRA as a standalone. You want to roll that over into solo 401k, and then because once you move it under solo 401k umbrella, you have more control, you have more options, and it just, it's simpler that way. But what some of our clients do is you can actually keep that IRA open and you can contribute each year $6,000 or $7,000 if you're over 50, and then you can immediately roll that over into solo 401k. So essentially you're maximizing your contributions. You certainly can do that. And then there's one more question we have about solo 401k. Can I have a solo 401k if I hire my kids as part-time W-2 employees? Yes, you can have a solo 401k and can have part-time employees as long as you keep them under 1,000 hours. Then you'll be in good shape.
Beautiful. And funny thing that anonymous, I don't know what your name is, but the anonymous attendee that asked that question just today, I had a client who is sending a child off to college next year. And he tends to make a little bit higher revenue through his business in the $300,000-$400,000 net revenue range. And he was worried about, his child not qualifying based on their household income for any financial aid or anything. And it's a very popular thing in the tax industry to hire your children at certain ages. And Dmitriy and I have talked about this at length of if they're younger and not going off to college just yet, can you pay them up to the standard deduction and not have to pay, Social Security, Medicare? There's creative ways of doing that. But then for children who are entering into college, you can actually put them on payroll, start their own retirement plans for them, create or not, emancipate them, have them file their own tax returns. And if I had known this way back when, as a freshman in college, I would have pitched this to my parents because they were both self-employed to put me on payroll. And by the time I graduated from college, I was a qualified buyer. somebody who had a tax return readily available to apply for a home loan, and I could have started my real estate investment life a lot earlier than I actually did. So, there are some very creative ways to put kids on payroll, to get the deduction, to fund money into their retirement, lowering your overall effective tax rate, saving you money while you're giving money to your kids anyway, right? That's the crazy thing, is that when your kids go off to college, a lot of times, I know that it's not for everybody, but in a lot of cases, when kids aren't working in college, their parents are funding their housing and their education and their meal costs and everything. Well, if you're going to give them money, why not run it through payroll and get them set up as a qualified buyer over the course of a 4-year period, maybe even putting money into their retirement? And that is a great way to start the transfer of wealth, especially if your estate exemption is almost at that $12 million level, right? I mean, maybe not everybody, but eventually with your real estate investment, some of you could be very close to that, depending on how many properties you've bought over the course of your lifespan. So there are some very creative ways to do that, to put kids on payroll and to give them a lot of those benefits, and also as a result, saving yourself significant income tax liability. So keep that in mind. That's a great question. Eric, great. You already got that started. So hopefully you can get that pushed through before the end of the year. Cost segregation is such a huge benefit, especially if you never plan on selling the property, right? Specifically, if you never plan on selling the property, because when you sell a rental investment, obviously you have to recapture that depreciation and pay tax on it, unless you're doing that 1031 exchange vehicle. So cost segregation, such a hot topic right now. I love the fact that you're even talking about doing that. So great.
Well, Tony, thank you very much for all the information. Awesome. And folks, I do encourage you to reach out to Robert Hall & Associates. They handle both my corporate and my personal taxes. And, I can't even describe how much money I saved. So definitely worth a shot, especially at this offer that Tony extended to you, reviewing last 2 years tax return. You definitely want to take advantage of that. But
yeah, and thank you, Dmitry, for telling all of your connections about the webinar. If we need to bring this topic back in a couple months, and once again, we'll be offering free webinars on a monthly basis for the rest of the time that I work as a tax preparer. So if you need more information on other topics, Dmitry and I can obviously set up another time to put a webinar together with any changes that come up in your industry or my industry over the next year or so. So we'll be in touch. Absolutely. Oh, no, Eric, yeah, I thought there was another question, but I think we're good. Dmitry, have a great night. Everyone, have a great night. Thanks for attending, and we look forward to talking with you.
Okay, awesome. Good night, everybody.
Bye, Dmitry.